Trial balance. Piece of cake.
In the previous video, we discussed journal entries and then how to post these entries into the ledger accounts. At a given point in time, usually at the end of the period, could be a month, a quarter, or a year, we wish to obtain a list of all accounts in the business in order to make sure our books are in balance, and that's where the trial balance comes into play. It's basically the ledger accounts. We put them in a list, each with its debit or credit balance. Accounts in the trial balance are listed in the following order. First, the assets accounts, followed by the liability accounts, next the equity accounts, mainly the owner's capital and drawings, revenue, and finally expenses. And for each account, there's a debit balance on the left and a credit balance on the right. If you're still confused by debits and credits, check out the video up here. But in short, assets, expenses, and drawings have a normal debit balance. Liabilities, owner's capital, and revenue have a normal credit balance. Before we continue, if you want to master accounting from the basics to the advanced topics, stay up to date, and future-proof your career by learning data analytics tools and techniques, make sure to give us a like and subscribe to the best accounting channel on YouTube. The trial balance helps to prove the mathematical equality of debits and credits. It's easy to spot using a trial balance if debits aren't equal to credits, but that doesn't mean that the trial balance can uncover every kind of error. For example, you can check out my YouTube video about a $6.2 billion accounting error made by the US Department of Defense in June this year. Errors that can't be detected by a trial balance include a transaction not journalized, a journal entry not posted to the ledger, a journal entry posted multiple times. In this case, debits will still be equal to credits, but the balances are wrong. Posting to the wrong account, for example, crediting accounts payable instead of salaries and wages payable. And finally, offsetting errors, meaning errors that cancel out. For example, overstating an asset like cash by $500 and understating another asset like supplies by $500, because in this case, the total debits will be correct, but the balances for cash and supplies are incorrect. Let's do this exercise together. We have a list of accounts with the balances amounts, but we have to determine if they're debit and credit in nature, and we are asked to prepare a trial balance. So let's begin. Remember, the trial balance should follow this order. So we start by listing the assets accounts. Assets have a normal debit balance. Then we insert the liabilities accounts. They carry a credit balance. Owner's capital is credit. Drawings are a debit. Revenue is credit, and expenses are debit. We sum up the two columns and verify that the debits are equal to the credits.
Let's do a quick recap. A trial balance is a list of all ledger accounts, each with its own debit or credit balance. In order to prepare a trial balance, you have to know two things. First, the order by which the accounts appear: assets, liability, equity, revenue, expenses. And you have to know the debit or credit nature for each account. Assets, drawings, and expenses have a debit nature. Liabilities, owner's capital, and revenue have a credit nature.
That's it for the trial balance. Very easy, I guess. If you have any questions or comments, please write them down. For more practice exercises, check the links in the description, and to stay updated, like and subscribe to the channel. See you in the next video.